We're back for another episode of the StoneX Australian Cattle and Beef Market Report. My name is Ripley Atkinson. I'm the Australian Livestock and Commodities Manager for StoneX based in Sydney, where we're developing price risk management tools for the Australian beef industry to help the sector manage market and price volatility with our Australian feeder cattle swap. We're brought to you by StoneX Group, a Nasdaq-listed global financial services network with 100 years of experience in global commodity markets. Remember that the trading of derivatives, such as futures, options, and over-the-counter products or swaps, may not be suitable for all investors. Derivatives trading involves substantial risk of loss, and you should fully understand the risks prior to trading. Past results are not necessarily indicative of future results. It's been a pretty hectic time in the markets since the last episode was recorded a fortnight ago. There's been a fair bit of movement in price, and I think it's probably fair to say the last six weeks of the market's performance has probably exceeded people's expectations, and the supply chain itself has probably been a little bit surprised by how rapid this rise has been, including myself. What we're going to get into this week, there's a couple of things. MLA's Beef Producer Intentions Survey report came out on Tuesday, which we'll have a look at. The strength of the cow market, how bullish sentiment, the rally in pricing is aligning with spring on our doorstep for a lot of places, and what that means, moving forwards. I'll start with the Beef Producer Intentions Survey though, and as I mentioned, the report was released Tuesday. It's a short report that only really asks 5 questions, and it's a bit of a sense check for the producers on their expected or forecast and actual sales results, changes or expected changes in herd size over 12 months, and adjustment to calving numbers or expected numbers for those autumn calving herds. So the figures are a reflection of 1 January to 30 June, and it's benchmarked against what the producers or the data the producers provided in that April report. In terms of what it showed, the change in the herd size or sentiment to change the herd size was relatively static. Nothing was really changed on those April results. 84% of producers remain unchanged on their outlook of whether they increase, decrease, or maintain herd size over the next 12 months. There was some slight positive adjustments upwards on the autumn calving numbers. It ended up that there was more autumn calves than expected in April. But the big takeaway from this report was most definitely the adjustment in sales numbers. So at a national level, there was 800,000 head of cattle less sold between 1 Jan 25 and 30 June 25 than what was expected in April. So in the first half of the year, effectively 800,000 head of cattle less were sold than expected. That represented 46% nationally of producers that sold fewer numbers than they thought. But the big one was really Queensland. So Queensland's producers accounted for 90% of the shortfall, if you will, in numbers for the first half of 2025. What that equates to is that Queensland producers sold 720,000 head less than they expected in April, which just shows the significance of the season in Queensland, but also, the results align quite closely with what we're seeing and hearing anecdotally, and as well through some of the data such as your Queensland throughput in sale yards. So, you look at Queensland's first half of the year sale yard throughput, it's down on 5 and 10-year averages, whereas your other states, southern states, New South Wales, Vic, SA, all their numbers are higher. So sale yard throughput relative to the first half of last year and obviously longer term averages, all well above last year and longer term average results. Queensland was the opposite. And what really is the driver of that is the season, of course, but the influence of those rains in March really can't be understated as to how much of an impact they've had on obviously marketing of cattle, but also, the effect they've had on the market. And because producers in Queensland haven't sold as many stock as initially expected, we're watching that play out in current price performance, particularly at a feeder steer level for 100-day crossbreds delivered into the downs. That's a great example of a lack of numbers being sold because of the season and the availability or luxury for Queensland producers to retain stock to add some weight, and the effect that's then had on a bit of a shortness of supply. So the producers within the BPIS survey also then provide a reason for why either more or less stock was sold in the first half of the year. Queensland's producers stated, or 40% of Queensland's producers stated, they retained cattle on the basis that cattle prices were going to be stronger. So either prices weren't strong enough or producers were expecting prices to improve, so they chose to retain. And then 35%, you could select two responses in this example, so it's not just a one response, but a further 35% also selected cattle hadn't met the target weight or weight range that they wanted to meet their target market. That was a really big influence as well. So when you combine those aspects, that's delivering us the shortfall of numbers of 720,000 head in Queensland for the first half of the year. And you're seeing that play out in markets at the minute, as I mentioned. Those, 100-day feeders delivered into the downs are a great example of that retention of stock on farm and what it's meant for markets, pricing and demand and whatnot. But when we look at those results, and there's obviously a few numbers I've thrown out there, but what does it actually mean? Fundamentally, it means more cattle supply in the second half of 2025 as numbers start to come to market. That doesn't necessarily mean we're going to see a rush of cattle. It simply means there's going to be, a growth and a build in supply come forwards in the second half of this year as producers start to move those cattle, which have met target weight ranges and met, price expectations of producers. And I think it's something I'll probably talk about a little bit later in this episode. But, when you're looking at the current market and how strong it's performed over the last 4 to 6 weeks, particularly the last week to 10 days, the expectation is some numbers will start to move as producers want to capitalize on those prices and they see that market strengthening, they want to get in and sell some stock and capture that opportunity. So, there's likely to see some higher supply as producers look to offload some stock to capture that opportunity in the next few weeks as well. But with rain on the radar, particularly in northern New South Wales, there could be a limitation to that because of access, etc., with the country so wet. But I think, when you look at that data and the fact that there has been such a shortfall and it's been so profound in Queensland, New South Wales and Tasmania in the report were two other sort of standouts in terms of reductions of numbers relative to expectations in April. But that Queensland situation, you can't underestimate the influence of that March rain and the capacity it's had for the producer to retain stock, their general outlook on the market and the influence it's had on supply and demand dynamics, which in turn have obviously affected price. I think the other big one, moving beyond that BPIS report and those, sort of more macro level data points, the real big one this week has certainly been the cows. I had a look at the figures from the yards this afternoon, and nationally the cow indicator's up 37% or $1 a kilo live weight in the past 6 weeks since the 14th of June 2025. And looking at the results, in my eyes, it's the sharpest rally the cow market's had on record, or at least since 2000, when the National Livestock Reporting Service began reporting of cattle prices in the yards. So it gives you a bit of an indication of how strong the reaction has been recently, in terms of pricing and the dynamics behind that. When you look at a state level, has there been one state outperform another? The response is no. Generally, across the states throughout the country, most of them have lifted anywhere between sort of 95 cents and $1.05. It's all been occurring in unison, and what's underpinning it fundamentally is the southern processes. Southern New South Wales, Victorians, and South Australians are driving this market. There's no question. They're effectively competing amongst themselves in northern markets to simply secure stock because they need the volume to take home to keep plants operating. That's the underpinning factor here. But obviously, the turnaround in season in Southern Australia in the last 6 weeks has been quite significant. Now, it doesn't necessarily mean grass production and grass growth, but what it's done is put some confidence back in that market. And you're seeing the reflection of that in a real tightening of supply as those southern producers start to gear up for a potential rebuild and obviously their peak, production period in pasture terms for spring. That contraction of supply that's happened quite quickly as those southern frontal systems have started to come through and improve soil moisture profiles. It's really forced those southerners to go hard in northern markets. And when you look at how the cows have reacted to that, it's been a couple of weeks in a row where they've just stepped up week on week. Armidale's report today, for example, cows in places up to 60 cents higher. It's a really good example, of what the southerners can do to this job at the minute and what they have been doing. And I think it also says a fair bit about the north. You're not seeing those northern processors be prepared to compete on price levels in line with the south, even with the additional, cost of getting those cattle home in freight terms. The northern processors just aren't prepared to go to those rates. That says to me a fair bit about the cattle they've got booked in front of them. But I would keep a close eye on northern processors' buying behaviour, particularly if some of those cattle start to disappear. And what I mean by that is space bookings. If cattle are booked on space at the minute, which through conversations, it sounds like a fair wear jar, if those numbers start to be dragged away from a processor and redirected somewhere else, you could see those northerners step back in, or in, another example, the case if you get some early rain for the change in the wet season or into spring and that sort of holds supply back from the market, you could see those northerners get back into it to compete with the south to try and secure some supply. But I think generally, that aside, without looking too far forwards, the lack of competition from the north gives you a good example of the number of cattle they've got in front of them and the sort of reduced need they have to compete with the south. The south there in the northern market competing against other southerners simply to be able to secure stock. And some of the buying patterns of the south, I'll touch on this a bit later as well, but you can see the south is looking at buying heavy feeders and are buying heavy feeders and other cattle types simply to secure numbers to be able to truck south and keep their plants operating. To me, that's pretty telling. The other one about this cow market, which in my view is quite similarly to Liberation Day in April, is that the effect of this announcement in the past 24 hours about the US placing the 50% tariff on Brazil, which is due to start on the 6th of August. I think what we're seeing here is these processors collectively and exporters moving on that announcement in preparation to be able to then sell that beef into the US market when the imported Australian 90s prices start to rally on the back of the market realisation, there's going to be, or the expectation anyway, that there's going to be a reduction in Brazilian beef supply into America. Brazil's been the largest year-to-date exporter or largest, supplier of beef into America from an importation perspective this year. It's quite well ahead of Australia in volume terms, and I think the market's realisation of the fact that there is going to be, a material reduction in volume because you've got the 50% tariff plus the 26.4% tariff rate, which Brazil are already paying because of that out of quota volume, which was hit in the third week of January. So effectively, there's a 76.4% tariff rate that importers will be paying for Brazilian beef into America. Naturally, the importers are going to look elsewhere. And where do they look? They look to Australia. And I think what you've seen this week in the cow job is a bit of a reaction to that dynamic coming into play. So 6th of August is when it's meant to come into effect at the 50% rate, which then you include the out of quota rate of 26.4. You're looking at a tariff of 76.4% that the importers will have to pay on that product. The other aspect, to think about here is it's very similar to Liberation Day and how that cow market, what I'll say is artificially spiked for sort of 2 weeks, or it spiked 2 weeks leading into Liberation Day and then sort of softened back to its rates that it was operating at beforehand. You're seeing the same thing happen now. The Australian exporters and processors want to get on the front foot here and get in to secure some stock so that, they've got the capacity to then sell that beef when the imported 90s price picks up and they can recoup a bit of profit, and they're prepared to, to step in now and get some volume in front of them with the expectation that the imported 90s price for Australian frozen trim is going to rally off the back of this situation with Brazil. When you consider how the South has operated so far this year, I think, it's fair to say let's expect Southern processors to stay hanging around in Northern markets, for well into the back end of this year. Add in the fact that I've just spoke about this US-Brazil complex with, tariffs and rates and whatnot. I think that will further, incentivize and push those Southerners to go hard in this market to secure stock. You've got to remember that the South did go through, particularly the Victorians, go through a pretty difficult time. The processors I'm talking about here with lockdowns and access to labour and, the damage that did to their businesses during COVID at a time when cattle prices went on a tear. I think the Victorians are going to do absolutely everything in their power to make sure that they can keep plants operating. And I mentioned it earlier, part of that is securing stock lines that you wouldn't usually think they'd be buying, simply to keep the kill chain operating and their labour workforce, which they've worked, quite hard to build back up post-COVID. They're buying heavy feeders now in Queensland markets to truck south just to keep people in work. And they recognise the importance of that because of what they went through a few years ago. Moving beyond, the cow job and the beef producer intention survey, we're looking at sentiment at the minute, and I would call the sentiment in the market quite bullish generally. Prices reflect that. We've got this dynamic here at the minute with feeder and slaughter prices, experiencing their winter rally. I don't think that should necessarily be unexpected. It's probably, or not probably, it has just been exasperated so significantly by, the lack of cattle in the South and the last sort of 18 months to 2 years of liquidation of the cow herd in Southern Australia, or the cattle herd in general, and what that's meant for an availability of, both grass-fed cattle, but also, availability of cows as well, and what that's meant for the demand, which is obviously so apparent in northern markets. But when you look certainly over the last 6 to 8 weeks in weather terms for the South, there's been a real recovery in soil moisture volumes, at a root zone level down south. And I think what you're starting to see now is these southern producers, that is, begin to behave with a bit of FOMO. They're worried that they're going to miss out if they don't step into the market soon, because if it's $5.10 today on a restock of steer, it'll be $5.30 next week. And I think a little bit of that fear of missing out is certainly embedded in that southern market, as people realise that spring is getting quite close. Generally you're looking at sort of 2 to 4 to 6 weeks away for a lot of places. It's not far around the corner. And with this continuation of rain coming, it's certainly aiding that hastened sort of demand to get in there and access stock while you can. I don't think, I don't think it's unfair to expect that to continue, particularly with, you look at northern New South Wales, in the last week, they've all had another sort of inch to 2 inches, with another inch to 2 inches expected in the next sort of 4 days. That effect is certainly playing a role in the spike in price, for restock of cattle in, New South Wales markets in general, but Queensland as well. You've seen them really pick up on light cattle prices in some cases in the last few days, and in others in the last week to 10 days. That reaction from the rain with spring, only a couple of weeks away for a lot of places has really driven producers to step in and buy cattle. FOMO is probably a part of that as well, because they don't want to have to pay 20 cents extra next week. But, the closer we get to spring, the more restock or pricing will come into focus. And that grass fever with northern New South Wales and Queensland, most likely to play out because of the fact that spring's assured for those regions following this really recent rain in the last, week or 10 days. That's going to be important to keep an eye on. When we look forwards and what to think about moving forwards, I just mentioned it, that grass fever or demand from producers now effectively right across the eastern seaboard, particularly New South Wales and Victoria, because of, an assured spring for regions north of Dubbo and the potential to recover and rebuild for the south coming into, what you call their peak production period in grass terms. I think we're really going to start to focus on that restocker job. In terms of where cows and grass-fed cattle stand in the next, to the end of the year, in the next 5 months, I think they're going to remain really strong. You add in this dynamic of the Brazil situation, and I think you're going to see southern processors remain in the north through to the end of the year. When you consider the potential for a southern rebuild and a retention of females, or at least, potential processor cows being bought by producers in the market to take home and join to rebuild, you're going to see those southern processors stay in the north where the supply is to try and access some stock. I think that's going to be the case for some time. But talking of the southern processors, watch their buying behaviour stepping into cattle types which you wouldn't usually expect. I've mentioned it a bit already, but there are examples of southern processors now buying heavy feeders in Queensland to take home, simply to keep chains operating. The challenge for the south, though, will be, the complexity of whether they're operating at a profit because of the cost of buying cattle. You're looking at cows now, bought in northern markets at $4.20 by a southerner, and that's before getting them home. It's a big expense and capital outlay to be doing that at the minute. And, how that affects their profitability in general and what that potentially means, for chain speed and how they deal with that is something to keep a close eye on. We've seen a bit of that example already in the lamb space, where a processor in the south has looked to pull back their chain speed and their workforce and sort of move their workforce around within the business because of the cost at the minute of buying lambs. There's no reason to suggest that can't be the case, in the cattle space for the south if this market continues for the cows. And I think, overall, we're going to see cows and slaughter cattle be very strong to the end of the year. I think we'll look back on 2025 and say the cows were the highlight. It wouldn't surprise me if we see records broken at a state level for cows in the next couple of months. Particularly with the fact that we're aligning close to a southern or close to spring with a southern rebuild and that further contraction in supply. I don't think it's out of the question to suggest cows can't surpass their records set in sort of 21, 22. That's all for this week. On the next episode, though, we've got Ryan Turner returning. Ryan's the StoneX director for meats and livestock based in Kansas City in the US from our US team. Looking forwards, really excited actually to have a chat with Ryan. If you haven't listened to the first episode of the podcast, we had Ryan on. He's got some really insightful comments to make. He's been in the game a long time, and I'm really looking forwards to hearing what he's got to say. So tune into the next episode released in a fortnight's time for Ryan's views on the US market, cattle prices, supply, beef production, all those sorts of things. If today's episode or any of the others have raised any questions, feel free to reach out to me via my email to ripley.atkinson@stonex.com. Send me an email, let me know what your question is. We'll get onto it in the next episode. Alternatively, send me a voice note where you're from and we'll get to answering it. Feel free to share the podcast with any of your mates and anyone you feel might be interested in listening to this. There's plenty going on at the minute. It's important to stay up to date with the latest moves and developments in the market. But until the next episode, thanks for listening. Take care, and we'll see you then. Cheers.